Welcome to this week's edition of Insider Secrets, the show that turns multifamily investing into reality. Each show we interview guests who are seasoned professionals, actively closing and managing real estate deals. Your host, Mike Morawski, has more than 30 years of multifamily real estate investing and property management experience. Mike is the founder of My Core Intentions and has been involved in over $285 million of transactions. Focuses on helping you create short-term cash flow and long-term wealth. Here's your host, Mike.
Hey, good afternoon, everybody, and welcome back to another episode of Insider Secrets. And I'm Mike, your host, and Insider Secrets is brought to you by My Core Intentions. And one question I always like to ask is, what are your intentions? Did you get up this morning? Did you think about what you were going to do, what you were going to accomplish today, where you wanted to go? Where you want your business to go, where you want to go personally. One thing I always say is our business doesn't grow professionally or our business doesn't scale unless we grow personally. And hopefully through the information that we bring you on Insider Secrets, that helps you grow personally because you expand your knowledge. And I always like to think about my knowledge or my brain as a rubber band, right? Every time I stretch it, it never goes back to its original size. Gives me the ability to put more in there, more to think about, more to grow with. Hey, at MCI or My Core Intentions, we invest in your future. We have a couple of educational platforms, some teaching events, some things that will help you grow. I want to empower you to execute sound real estate principles and property management skills while living a quality and well-balanced lifestyle. One thing I always find is that in real estate, we can get so stretched in many different directions that our lifestyle gets out of balance. And if I can help you to live a more quality, balanced lifestyle, to pay attention to the things that really matter most, maybe like family, maybe like some personal time, some quality time that will help you get back in balance, then that's what I want to do for you. But I'm looking forward to today's show. Today, I'm excited about my guest, Dan Kryzanowski. Dan, you want to say hi to everybody real quick before I intro you?
Hey y'all, Dan K. Greetings from Austin, Texas.
Hey, Austin is a great city, that's for sure. Hey, Dan is an active real estate advisor, investor, and partner who has raised millions of dollars across multiple channels, including accredited investors, family offices, and investment advisors, while empowering his partners to raise 7 figures on multiple occasions. He specializes in niche segments such as industrial and self-storage, complemented with a deep knowledge of the tax advantages that go along with real estate investing. Dan's a Wharton graduate. I'm impressed. Previously led commercial real estate initiatives for GE Capital in Mexico and South America. He's received an MBA from Thunderbird School of Global Management, graduating with a distinction and top honors. Dan holds a Series 7 and a Series 66 license, is a licensed project management professional, and recently served as corporate board president for Hugh O'Brien Youth Central in Texas. Dan lives with his wife and his son in Austin, Texas. And Dan, I'm glad that you're here today. One question I always like to ask my guests, Dan, right away is, in one word, can you describe for us what best describes you personally and professionally?
Passionate.
Okay. Anything specific right now that you're passionate about more than something else?
Yeah, I'd say for a lot of us Gen Xers out there that have children later in life, I'm all in with my son. If we were here on St. Patrick's Day, I'd be wearing my green and holding up a Guinness. He's a St. Patrick's Day baby. So although I am here in Austin, I grew up in Scranton, Pennsylvania, on the Irish side of the tracks. There must be some higher power out there that has you do that. I'm pretty all in with that. At the same time, it's education. When I think I say passion, we all have different backgrounds, different stories. We grew up in different towns, different assets. I'd say my mission here is that, particularly when it comes to investing, just being aware what's out there, as long as everybody has the equal level of education, then I feel good about it. We're all big kids thereafter. I want to make sure that everybody has the opportunity and the know-how that they can access what is theirs to invest in what they want or to provide for their community.
Yeah, interesting. And Dan, I got to call you out right away, right up here up front, talking about St. Patrick's Day, and your last name is WSKI, just like mine. Us Polish guys have to stick together. Come on.
I grew up in the Irish part of an Italian town, but I evened it out. When I lived in New York City earlier in my career, we lived in the East Village, a block from the Polish church, the Polish restaurant. So I did have VIP service for 4 years to make me feel good about things.
Yeah, if you're a traditional guy like me, I'm thinking about Easter coming up this weekend, wondering where there's a good Polish delicatessen to go buy some good sausage and some rye bread for Easter. Just a thought. Hey, Dave, listen, we covered a little bit of your backstory. Fill some blanks in for us. Would you tell us a little bit more about who you are and how you got into the space you're in and actually what you're doing today?
Yeah, and thanks. And I do think things skip a generation. When I think back to my grandparents on all sides and old aunts and uncles, they were the first generation that was born and raised here, probably through the Depression, World War II, et cetera. They were very entrepreneurial. They saw the value of land, owning a business, bartering, et cetera. And then you can argue our parents' generation, no fault to them, but they grew up with W-2 jobs. My dad was a teacher, coach, principal. He didn't have a resume till he was 60 years old. My mom was a social worker. Probably for me, it's not in my DNA to do. I'd say the value that she provided for folks was exponential, obviously not a high-paying job. I share all that because growing up also in Scranton, PA, and politics way aside, but President Biden showing his inside backstory, we grew up a few blocks away from each other. Probably the same nuns, the same school, the same Little League field, all of that. It really does, if you think of just Kiyosaki's book, Rich Dad, Poor Dad, it doesn't really give you the kind of rich dad mindset from there. And I appreciate you sharing my full intro. Thanks to listeners for listening in there. I don't even want to say fancy, but say expensive schools and stuff that I went to and such. That really doesn't give you a wealthy mindset. I think what it did bode very well in the 20th century. And I would also say, for me, it was right place, right time to, we joke a bit, but to be the Polish guy in an Irish Italian town, you're the tallest guy in the basketball court. And it makes it a lot of fun. And growing up as a kid in the 90s, it was blissful in Scranton, Pennsylvania. The benefit from that, fast forward a bit, I was a beach bum for a few summers, lived in Spain, went to Wall Street. That was the thing you did back in 2000. And I half joke, I was very grateful for a gentleman from my fraternity to give the offer. And you show up the first day and guess what? He's doing something else at the company. So right off the bat, you learn of how the real world works and how to maneuver and negotiate and such. But enjoyed my time in New York, just didn't really see a career. I went out to Thunderbird for my master's. Great experience. I've always had that. I wouldn't be surprised if later in life we're doing a State Department job somewhere. I've had folks in my family that have done it. It's in my head and heart. But the end result of that, once again, was GE Capital. 15 years ago, which seems like an eternity, but GE was voted top company in the world. Right. GE Capital was we're not even around anymore, the hot financial shop. And this was a great experience for me, having the global backing, doing global deals on the real estate side and other businesses. I would say, though, in head and heart, I knew that's probably where my future wasn't going to be doing the commute or reverse commute in Connecticut or New York City, wearing the khaki pants all day. There was a little bit more. My wife and I, and almost 10 years ago to the day, I did a one-way ticket back here to Austin, Texas, and it's been quite a ride.
Yeah, it's interesting in how our world changes and how things change along the way. So I think because of the environment and the things that happen around us, it makes us make different choices and decisions. And that's what it sounds like for you. You mentioned GE, right? And even when I read it in your bio, I went, man, they were a huge company. And years ago, there was a book written called Good to Great. I don't know if you ever read it, by Jim Collins. And he talked about what it took a company to go from being a good company to a great company. And GE was one of those companies. And he talked about how GE scaled. And then all of a sudden, they didn't continue to do what they needed to do to be around to withstand the test of time. It's interesting how that happens. And what do you think something like that is? Do you think that you wind up resting on your laurels, that people get comfortable and they feel like we've got this?
Yeah, when the chart is pointing upward, it's tough to knock it off coaster. And a real example, as we're taking this and maybe listening in the year 2025 or 2030, we may be talking about Tesla to say, remember when they used to do cars and batteries and now they own every 50% of all Bitcoin and tokens and such? And maybe that's what they become, and they own half of the world's currency. On the flip side, if let's just say coins, Bitcoin, et cetera, flattens over from now for the next 10 years or drops, and they invest in not just, I think, the $1.5 billion they said, 100 billion or so, then oops, they might have a cash crunch. And for one reason or another, whether it's business-wise or political, they can be out of business. Both of those are an extreme, but I think in a similar vein, when you leave your business's core intention, your core mission, you really leave yourself out there, particularly if it becomes a majority of your assets, a majority of your revenue. Sometimes it's a life-saving play, like with eBay did with PayPal, which you can say they were quasi-connected, so it wasn't that far away. But I just view the lesson I think with GE is you have this manufacturing company that got into, for all effective purposes, levered banking, and that party only goes on so long. That said, a few times your sales, and obviously there was discussion for our GE folks out there, both in the real estate and credit card business, to maybe dispose in the 2000s. It didn't happen. That would have made Immelt and others look like a genius, and that would have been so much more. If that was invested into who knows what, maybe GE would have been still talking to them as one of the top 5 or 10 companies out there.
Yeah, it's interesting. So in your own personal career, what's been a real defining moment for you to take you to where you're at today?
Yeah, one is just, of course, leaving GE when I did. Obviously, 2008 happened to everybody, but 2011, that was still an entity. It still meant a lot if you were in finance to live in the Northeast. I came to Austin before there were any, outside of 6th Street, there was none of the hipster bars on Rainy Street. You still knew all the acts that were coming to play on South by Southwest. You pretty much knew everybody in town. But now we're in this true sort of adolescent stage. I think the first thing was just the leap of faith to come to Austin, I think was very big. And then I'd say, like anything, 5 years in, making the decision if I wanted to stay more with smaller companies or on the entrepreneurial route or bounce back up. We have Dell, AMD, Dimensional Financial Advisors on the finance side, and I chose to stay a bit more on the entrepreneurial side. So those were, I'd say, 2 notable points on the timeline. I think most specifically is, so what are you passionate about when you tell your backstory? And I found myself being excited to say, hey, I was co-best man in a friend's wedding. I asked this guy what he did. He said he flipped houses. I said, that's great. He said 15%, my ears lit up. And then he said, did you know you can use your retirement dollars? And that's when the light bulb went off. And that was many years ago, and it led me to a self-directed IRA, passive investing, how life plays out. I was on a plane with a gentleman whose previous company, Goldman Sachs, bought. Next thing, I'm one of his early advisors, investors, and stay on as employee 1. And taking that now for the confidence to be on my own, partner with who I think is one of the top real estate shops across all of Texas on the BV and Archway side, and feel confident that my interactions with folks and my reputation are at least going to merit a conversation to share a bit of education and a bit on our offering and vice versa. That's where my chips are for the next few years.
Yeah, interesting. This conversation about GE is interesting. And I was in Dallas doing a deal, and we were in a GE office in Dallas, and this was 2009, probably summertime of 2009. And I had somebody who I was doing business with in Dallas, who I built a really good relationship with, said, come on, let's go to GE. I know these players there, and I think that we can get some good debt and maybe even some equity. And I remember sitting in this guy's office saying, you can see what's happened. Lehman Brothers was gone, Bear Stearns, AIG. He says, I don't think we're going to be around much longer. And it was a very interesting conversation. And I remember leaving the building, looking at my buddy that day saying, hey, I'm finding that conversation hard to believe that GE, and the guy said to me, man, look what happened to Bear Stearns. They were around 100 years. And AIG took a bath. And when you start to look at those major corporations like that, I remember sitting at lunch with my CFO in 2008, and they were carrying boxes out of Lehman Brothers by the truckload. And I looked at him and I said, man, we're screwed, aren't we? He goes, yeah, we're in big trouble. And so the world imploded back then. The good news is I think that things are righted now. The ship's floating again, and the markets are stronger than they've ever been. But which brings me to a question. Do you think we're going to stay like this? Or do you see a looming effect that's going to happen here in the markets?
I joke because I know our conversation here is going to be played a month or two down the road. So I'll caveat with that. The one thing I think with all this is, let's assume and hope more folks are vaccinated. We're on Lake Michigan or our beach right now. We're enjoying ourselves for the summer. I think the big thing here, and I've talked to some really bright folks, some humble folks that have been analysts for 20, 30 plus years. And I think it really comes down to the money supply. So let's take a real elementary. Let's say when the ball dropped in 2019 to 2020, an apple costed $1. Okay, let's say as COVID went along a year later, it's $1.05. And now as we sit today, let's say it's $1.10. So a little bit more than inflation, but not too much more. But real estate, and this is no exaggeration, in some markets has doubled, because you're seeing houses selling, a $600,000 house selling for $150, $200 above ask, like real deal, 50% or doubled. So the question here is, and let's just take extremes, the Apple went up 10%, the real estate up went 100%, and money supply doubled, AKA went up 100%. What's correct? What's valid? Is the Apple going to go up that much? Or do we almost sit that we have two different markets for consumer perishable things that you buy versus an asset like your legacy wealth? And somebody's going to say, listen, my house is worth 1/over fraction of the money supply. And because that doubled, my $500,000 house is now worth $1 million. And people are going to say that's that. You know, what it does, I think, it's really going to continue to divide. I think the haves are the have-nots. The folks that think of wealth and actually have some sort of equity ownership, which once again could be as an LP, if you are riding that quote unquote, say, inflation or higher priced wave. And folks that we think of our parents' generation that saved up. Why? Because their grandparents grew up in the Depression. So all that money under the mattress, maybe you can buy a few apples, but you're just never going to reach a house. And that's historically, this has really hit lower income communities of color, but it's really going to hit, I think, your middle of America, white middle class, that they're just not going to be able to buy. In Austin right now, it's comical. And I'm sure across the country, even in Scranton, PA, talking to my cousin, she's an appraiser up there today. It's the same thing. The supply is 1/5, 1/10 of before. Offers are 10x, 20x, meaning the number of people coming in. Is this sustainable? As I said, if it's like anything, if everybody agrees that the game is going to be played this way based on the amount of money supply out there, then guess what? You're going to have very unique markets for housing and then your day-to-day. And the other thing I would say, versus we talked a little bit about 2008, the difference here is people are paying with cash. Yeah. So it's not like people are levered here. So in many ways, people are saying, well, guess what? There's just a lot of cash out there. And as I said, I think that's my advice for somebody that, you know, has been working quote unquote hourly or saving all these years. You know, it might be very uncomfortable, but sometime between now and not too in the near future, you're going to have to put a chip in. It's like poker. You're at the big kid table now. You're gonna have to put that chip in and buy a house and ride this wave, or you're not really giving your family that sort of wealth that I think one's gonna have to rely on going forward.
Yeah, it's interesting when you talk about pricing, and we could say that, yeah, this episode's gonna run in a couple of months from now or 8 weeks from now, and that's okay. But I want people to listen to this because this will happen again. The market is cyclical and we go through these cycles, but here's something that's really interesting. I'm getting ready to build a couple of single family homes and we're trying to go vertical pretty soon here. And what's interesting is the conversation with the builder's been like this. Pre-COVID, we could build this for 110 a square foot. Today, it's 133 a square foot in a year's time. Okay, that's a big jump. That's a lot different than your Apple being $1 10 years ago and $1.10 today, right? Sure. And I had a friend call me the other day and he goes, hey, I'm at Home Depot and 2x4s are $7. He says, when do you remember an 8-foot 2x4 being $7? I said, I don't. I said, a year ago, I was buying 2x4s at $2.33. Yeah. So the cost of material has accelerated. Cost of food's gone up. Cost of everything is going up. It's an interesting time and place. I think people need to be aware of what's going on because I think that we're going to wind up in a place. And I told you when we started this that we'd end up in some rabbit hole.
Let me push it even deeper. Let's think in terms of 3 weeks. The stock market, it's been at an all-time high, it seems, the last few years, outside of course, March of 2020. And the question here is high level. So I referenced my first boss, great gentleman, moved to Vegas. We had dinner in Vegas a few years ago. And he's like, stock market's fine. It'll be fine for the next 10 years. And he's been through many cycles. And so he could tell me why. He goes to the bathroom, comes back, and I list everything. He's like, listen, all the big pension funds, the CalPERS, Timco, et cetera, what are they going to get in a bond? I'm like, you're right, 1%. What are they going to get in cash? 1 basis point. Because of that, you keep on feeding sort of the stock market animal that goes in. When you just think of ARC Financial, they're a big holder of Tesla. Once again, does PE make sense, or is it just a separate vertical, much like how you can say Bitcoin is going to be, and these are going to be the rules of these games? And like anything, when a lot of folks go in, they don't want to see the bottom come out. The question here is, I'd say until there's still pensions, there's still people that are going to only think in terms of stocks and bonds and funds. They don't want the floor coming out of that ship. Could equities stay like this, maybe not at the same acceleration? Once again, sure, why not? Because I always bring it back, there's a lot more money supply. And what other currency can you go into when you talk about that? What other physical asset that can do something now? And I'll finish here on the fourth dimension. I heard at a family office show, they said if every millionaire wanted a Bitcoin, as in Bitcoin, they can only own 1/3 of it, which is a kind of a wild fact. So it's, you know what? That's probably, could it hit $1 million? Sure, of course. It's really bringing that back to the Joe Jane America in terms of, if you're not as versed in private investments, hopefully we are educating some folks today that I'd say one takeaway is realize your retirement dollars, your old 401k, your old IRA, you can use that to invest passively in real estate, into friends' startup, to buy Bitcoin, a female entrepreneur, to invest in your community. All of that is in play. Most folks still may not hear that message, and they're going to be thinking of the 20th century way to make money, and they're limited because they're not in these other sort of verticals that, frankly, when you cash out, you're going to cash out for a whole lot more dollars. And I don't think folks are going to want to rock the boat collectively. I think that brings to more of a societal, do we reach a societal boiling point? Or does it seem like one of these movies where there's certain folks living on the top of the hill and everybody else is at the bottom, and that's just the way it is?
Boy, that's scary to think, even because that disparity has gotten that bigger. And I remember growing up, it was never like that. But hey, when you look at cap rates right now on multifamily, or on any asset class actually, but let's talk specifically multifamily for a minute. Cap rates are so compressed.
Mm-hmm.
Can they go down further, or does there have to be some kind of an expansion here? Can they contract more, or what do you see?
Yeah, I think it comes down to is obviously big money is involved. And there's two types of big money. One is one that has to show their investors are doing something and pay a dividend, or at least keep Wall Street happy. And the other one is just on the private side that has to move money. In short, I would say yes. I'm more versed, I think, in self-storage and some of these niche real estate asset classes. If somebody wants to be here in downtown Austin, they might even pay a sub-5 cap rate just so they can have a print in downtown. And that's no joke. And you'll probably see one of the publicly traded REITs do that. So they get a headline, and the folks living here, they'll jack up rent 10, 20% right off the bat, and nobody will really do anything. So it'll all work out in favor. On the multifamily side, it comes back to, I think, the amenities and stuff. And I don't think people think when they pay the rent, this is 40, 50, 60% of my gross or net wages. I think especially now, I don't know if people are going to really realize that it'll be less of an interest or urgency to save. I'm here in downtown Austin. Post-COVID, people are going to want to live here. People will pay up a lot. So I think the rent is going to, from a cash flow standpoint, you'll be fine. And I think there's always a lot of people, especially multifamily, want to get in. There's a lot of coaches out there, but eventually they're going to raise their million or a few $1 million. They're going to buy the property. Maybe they don't underwrite it as well as possible. So yeah, frankly, this could, I think, be, in my opinion, 5 or 6 years before we really have to take a deep breath and say, things are way off, or I'm really going to cash and I want to be the first guy to take my money off the table. But I think we have another, 5 years to go.
It's interesting. Listen, I remember there was a time when you looked at an A-class deal, and an A-class deal was probably at a 5.5 cap rate. And I remember having this conversation. Well, when you take the investor in an A-class deal, and they're a hedge fund, or they're a teacher's pension fund, or a union pension fund, and their only obligation is to make sure that their investor gets a 4% or 3% return on their investment, and they keep a percent for the management fee, and the rest is profit for the fund. There was a time that math made sense, but also at that time, B-class assets were trading at, I wrote a book called Exit Plan. Somebody called me up and said, "Did you really buy this deal at a 13 cap?" Yeah, I did. But today that deal is trading at a 5, a B-class deal, and it's probably a B- deal today, just because of the age, not because of the operations of it. So it's interesting, those dynamics, those metrics, and where you have to find your footing and where you have to find your place. Let's talk about this. Let's talk about raising money, right? So when you raise money and you're in this dynamics right now, what are you saying to investors?
Yeah, my first is always just my high level mantra to say, did you know you can use your retirement dollars to invest?
Yeah.
Even if you have a guy or a gal that works at one of the big name financial shops, this is your money. You have full access. You have full control over it. It's your decision. From there, I look at it as a barbell strategy. Let's just take C plus workforce housing on one side of the barbell. This is probably going to merit a higher dividend. So I'll give you 2 real deals I invested in this year. This was an 8 pref, and we're looking at a 24 plus IRR. A similar property these guys did, they have a great track record, was a 53 IRR. Now, why do I feel confident? It's the same team that did this 53 IRR, and some of it, of course, is right place, right time, but the lessons that they learned, they imminently put it into this deal. So it went from a sub 60 occupancy. The pool hasn't been open in 3 years, and you want the pool open in Texas. It gets a little toasty here in the summer. And within a few months, they had the occupancy up to 90+%. The economic occupancy was up to 90+%. That said, it's still a workforce. Things can go wild. There's things out of your control, like with stimulus checks or not, or the legislation, although we think we have a pretty good idea how something in the Dallas-Fort Worth market would go based on local politics and at the state level. That said, let's just say there's a little more risk attached to that. So that's one side of the barbell. So if folks are comfortable, and ideally probably not the first time in, this is a pretty good deal. On the other side, somebody says, my money, I got scared, I got tired during COVID, I have $200K on the sidelines earning 0.01% at my big bank. I'd like to do more with that. What is very secure out there? Almost like, what is a bond wrapped in real estate? What's the equivalent of equity returns at a AAA bond level? And that's something like industrial. Think of somebody, it's an industrial company, they're cash flowing like crazy. It's a mission critical property, meaning where they manufacture something or their headquarters. They probably put X million of their own money in a build to suit property, and they're on a 15-year lease. So they're not really going anywhere. And the lifetime of this deal was actually a fund was only 5 years. When you looked at that, and there's multiple tenants under this same top credit, very attached to the property, and this was paying a monthly dividend. So this gave you a warm and fuzzy. And then cherry on top, some of these deals don't pay on the back end. This sponsor was paying on the back end. So when I viewed it, okay, your stock's gonna make 7-8% with all the volatility. Oh, by the way, this is gonna be equivalent of 14%. And here's additional tax benefits on top of it. When you lay it out like that, hopefully folks say, yeah, this merits me moving 10% of my portfolio finally into passive real estate.
Interesting. Now, you've raised a lot of money over the years, haven't you?
I've been fortunate, yeah, thanks.
When you're raising private equity, how do you go about doing that?
Yeah, so it is a relationship, and I always find if it's an individual, of course, seeing their level of education, level of experience, number of deals they've been in or not, that's one side. The other side, when you are talking to, say, big money or institutional, there's a huge difference from talking to a private equity shop that's going to want quote unquote private equity returns. Family office generally is going to want control. Also on the operational side, if they also have been in that same space as you, that can make sense. Sometimes I chuckle a bit when somebody says, oh, I really want to get into self-storage, and you introduce them to the top operator in the space, and they say, I'll invest, but I want to have a clause where I can fire the CEO. I'm like, you're missing the point. This guy has a 20-year track record here. Finally, what I do like is what I'm realizing you mentioned it before, Mike, in the pension space, in these insurance company spaces where folks that kind of syndicate together with infinite banking. So you basically have to hit a certain target return, but it's almost, you need like as close to a guarantee of return of capital as possible. I think some of these folks, it's becoming a warm and fuzzy where real estate, to my barbell example, industrial real estate in my little world is really becoming something that fits because they're going to view it, unlike you and I that are probably going to view it from the return first, they're going to view it from the risk profile and say, wow, I really love the risk profile of this. And you're paying me monthly, and it's asset backed, and this, and you're going to give me a return on the back end, and it's only a 5-year term, and I can pull out at any time, et cetera, et cetera. Wow, this looks really attractive.
Yeah. Do you ever see yourself, or do you ever see those types of deals getting to a place where people go, man, this is too good to be true?
I'd say more yes, and I chuckle a little bit. I spoke to a gentleman, as I said, when things are on the up and up, so let's just take basically the whole 2010s. I know some folks that have been involved with, called the pension funds and such of the world, and it wasn't the next shiny object, but it was the person that was in the headlines. And I think they invested with the headline as opposed to really doing their, I don't want to say diligence, but if this person was not known objectively, they probably would not have invested with them. And same deal where I think individual investors, you have to be cautious. Like I always say, like when I invest where there's a team or partners instead of one person, there's just too much that can go wrong or too much on one person's plate. So more at the mom and pop level, I know that's the lesson I learned early in my investing career that you might want to avoid. Yeah, even if the check is 100K or call it 100 million, I think you really have to abide by, here's my diligence checklist, regardless of who the party is.
Listen, I'm looking at the clock here and I can't believe how fast this time went. I could talk to you about this for hours. This is probably a higher level conversation than I've had recently on Insider Secrets. I have a couple of questions I need to ask if I can. What advice would you give a investor in the multifamily space today?
Yeah, I would say invest to the most conservative pro forma. And if somebody's not showing that, or a worst case scenario, or they're claiming there isn't a worst case scenario, I would say run. I think it's a fair, even if you are that first 50K, 100K check, you deserve the right to look at the base case, the optimistic, and the worst case, and base it off of the worst case.
Yeah, I talked to somebody today. They're underwriting deals. They're putting 25 basis points per year on a cap rate accelerating and going up as a conservative underwriting piece. And I thought, man, that's a big number, a big push on that, but I think that's right. And that goes back to your 5-year model that you said earlier in the show, because over 5 years, that cap rate is going to come up 150 basis points.
Yeah, and one other thing I'd say on that too is we're all investing across the country here. Really think if you're multifamily, like a lot of real estate, you do the 1, 3, 5 mile circle. If a town or an area is very reliant on one factory, one company, maybe they've had a bit of good luck for one reason or another, you do have to discount that. Whether you say, hey, this is the local unemployment rate, you can't say, oh, it's going to be at 2% forever. What was it 10 years ago? It was 8%. You know what? Let's put 8% on the model.
Yeah.
You know, how do the numbers play out? Then am I then comfortable investing?
Yeah. So I have a guy who double checks my underwriting work from time to time, and he'll ask me, he'll say, listen, on the terminal cap rate, have deals traded in your market at this? Have deals traded at this price per unit? So I think that it's always conservative to look back at that and say, you know, are things traded? Have things ever traded at this number before? Because if they are, then there's a good chance that in 5 years from now that they could trade at that number. It's interesting. So I think you have to be aware of it. Hey, Dan, let's get on the lighter side a little bit. Sure. So I know you're down in Austin. I love Austin. It's a great city, but favorite tourist attraction?
In Austin?
Yeah.
I'm going to say Mount Bonnell, because it's only about 100 steps. But you go up there and you get a panoramic kind of view of the city. And I like to say, you look downtown, you look everywhere else, you see old Austin, how it was with the lakes and river, Colorado River dammed off, and the beauty looking to the hill country. So it's easy breezy, it's known, but as I said, it's only 100 steps. Anybody can do it.
Man, and I thought you were going to say Coyote Ugly.
Those days are long gone, and that's, like I say, wait till football season when 6th Street opens up again. It's going to be a party, I'll tell you that much.
Yeah, I bet there's got to be a pent-up demand. How about best restaurant?
This is something we can definitely talk about for hours. I'm going to share my bookends, which makes me very happy. I share 3 things. Stinson's, 45th and Burnett for my Monday morning coffee. The team's great. It's in an old garage. It feels great. And they do have some of the best cold brew in town. On the flip side, especially if people are coming here with kids, Little Deli Pizza. If you feel like you're in a 1950s shopping center, it's BYOB. It's probably the best pizza, I think, in town. That's a Friday afternoon. And then there's a lot of talk about Tex-Mex, but Fonda San Miguel has, I think, a 40 or 50-year run. And this is true Mexican. It's on its third or fourth generation of Austinites alone. That's just things I love in my neighborhood. And there's a whole lot more out there.
Yeah, awesome. Best book you've ever read?
Very recently, it's Skin in the Game by Taleb. He wrote Black Swan. And I'm going to say something very lovingly for folks that have kind of my CV and background, for better or worse. He talks about IYIs, intellectuals yet idiots. Now, he's talking more about, I think, the academic world and some of the major media. But you know what I do think, putting that together with the title, Skin in the Game, for folks out there that are going to take the leap, it's like anything. Are you going to invest or not? And listen, it doesn't have to be a huge number. It might even be literally 1% of your assets. It could be as low as probably 10K in some of these real estate deals. Are you going to make that check? Are you going to do this? A lot of times it's been about the commitment, not the dollar amount, which really extends, I think, the depth of the relationship. So for me, that's my reminder. It's like you really can't look back, and the world is moving way too fast to say, here's what I've done previously, or here I've done this for X years. That's pretty, in some instances, a net negative potentially. So just the reminder of skin in the game. If you're going to be in it. If not, it's okay.
Yeah. And a lot of times too, I think skin in the game goes beyond just the capital. Roll your sleeves up and get in it. Hey, Dan, this has been great. And unfortunately, we really didn't talk about self-directed IRAs at all, which was one of the intentions of this show. So we'll probably have to have you back or have somebody on that talks about that. But I want my listeners to understand that self-directed IRAs are a great vehicle to invest in real estate in, to invest in alternative investments in. If you have an old IRA from an old company that you worked for, something laying around, roll it over, put it in a self-directed so you can use it in real estate. There's some restrictions and some stipulations, but from a high level, it's a great place to earn tax-free dollars on your retirement.
Yeah, and I know NAR, Association of Realtors, is with you in Chicago. Maybe this teases up for our October discussion, but for the 1.3 million realtors that are 1099, there's something called a solo 401k, where you can actually contribute over 50,000, multiply that by 2 for husband-wife team without W-2 employees, where you can contribute over 100,000 per year, take that bucket of money to invest. Super, super powerful. Once again, another thing, it's not as well known, but once it is, people really find it beneficial. I'd love to come back, speak to your audience, say when we're all back to school in September, October.
Yeah, that'd be great. And actually, I have an event, a 3-day virtual event I do in October. Let's talk about you being on a panel.
Beautiful.
And we can work that in. Hey, everybody, thanks for being here today. Dan, tell people how they get a hold of you if they want to pick your brain or talk to you a little bit.
Sure. LinkedIn is great. Dan Kryzanowski, not too many of me out there. Please reference that. I check LinkedIn probably every few hours. I love the back and forth interactions. Please mention that you heard me here on the podcast.
Yeah. And not to be confused with Morawski. Easy not to confuse. Hey, Dan, again, thanks for being here. It's been a great pleasure. And this was a great conversation. Very substantial is what I like to say. Good intellectual knowledge. Not your typical how to do something, just really from a really high level view of what's going on. I encourage people to listen to this a couple of times. There's a lot of good data in here. Hey, everybody, until next week. Hope you enjoy this, and we'll look forward to seeing you soon. If you need anything, reach out to me. And as a quick thought, remember to go out there on social media, connect with us, connect with me personally and my core intentions on Instagram and Facebook and Twitter. Like us, love us, help our ratings, and that way you'll get updated on this stuff all the time. Look forward to seeing you next week.
Thank you, Mike, and thank you for joining us for another great episode of Insider Secrets. As always, Insider Secrets is brought to you by My Core Intentions. Join us on social media and visit mycoreintentions.com, where you can get expert coaching on all things multifamily investing and property management. We're looking forward to having you back again next week for more Insider Secrets.